Well, hey there, everyone. Welcome to Chart This with Dave Keller. Happy Wednesday, December 17th, 2025. I am your host, Dave Keller, coming to you from a kind of, kind of decent Redmond, Washington here. The flooding has restarted here. We got a couple of roads closed around us. Looks to be, knock on wood, not as bad as it was over the weekend, but still going to have some road closures. If you are in the Seattle area, hey, come to the Seattle Symphony, including the Seattle Symphony Chorale, of which I am a member, singing the Hondo Messiah, a beautiful piece of music, and hopefully very, very well performed. We had a great rehearsal last night with the orchestra. Excited for a dress rehearsal tonight. First performance tomorrow. Hope to see some of you there. It's a good piece for sure. Rain and flooding and music aside, not a great day for the markets, and very much a risk-off feel to the tape today. Energy, which was an absolute disaster train wreck of a chart yesterday. We dug into all the different energy ETFs today, leading the way, not down. Actually, one of the few sectors actually in the green today. And, nice rebound day after yesterday getting crushed on weaker crude oil prices. Today, it was growth, which was up yesterday, all struggling. Technology at the bottom of the list. The AI trade continues to be unwound. Charts that looked absolutely unbeatable look very beatable here, as Broadcom and other names have initiated a pullback last week and continue to follow through today. So a lot of charts to talk about. Some things kind of breaking down in a number of ways. Could be a sign of further negativity here as we get into, December, honestly, traditionally one of the strongest months of the year. But again, this has been an unusual year in so many ways. And so when we're looking at the month of December, I was tempted to think, well, December is usually a very strong month. Things that have usually been strong months have not been particularly strong in 2025, and months that are usually very weak in a post-election year have not been particularly good. So it's been a weird year, to be honest with you. With that in mind, let's talk about what happened today. So the structure of the show, let's look at the markets. We'll just check in on what happened today and make sure you're familiar with all of the movements. Then we'll look at the heat map and really think about what the leadership and laggardship was within the equity space. Then I've hand selected some charts to share with you. If along the way, any of these things I'm about to say elicit some question from you, please take a moment, won't you, and drop a question in the comments section on our YouTube channel. We're planning an all mailbag episode on Friday, and we would love to answer one of your questions on the show. So the S&P 500 up 1.2%, closing just above 67.21. The NASDAQ composite down almost 2% today, leading the way lower, officially down 1.8%. It accelerated into the close to the downside, made a new low literally at 4 p.m. Eastern. Dow down about 0.5% today. That's your best performer. Mid caps and actually small caps a little bit less. All the major indexes were down, but the small cap index only down about 0.33%. It was actually up a decent amount right out of the open. So it was very much in the early hours, large caps down, small caps up big. But this is the problem. And when we talk about, when people are saying, well, the market's still fine, it's just a leadership rotation. Like, we are in agreement about the leadership rotation part, but is the market good, right? Are the markets good? The argument for the markets being fine is if technology and communication stocks rotate lower and all the AI trade starts getting unwound, but like financials and energy and industrials and maybe some defensive sectors do well. Isn't that enough? And that would be okay. Or that would be a good scenario in a bear market for a lot of things to do well. But I think what you saw today with small and mid caps is the problem, right? Earlier in the day, small and mid caps were up a decent amount, while large cap technology was down. But if you look what happened, the weakness in the NASDAQ gets so big. And I think I have yet to meet an investor who doesn't at least have some exposure to the AI trade, whether through some major vehicle like the QQQ or a stock like Microsoft or Alphabet or something like that. And the problem is, if those names, which have done so well, start to struggle, it's not, there is a world where everyone kind of calmly rotates to like energy and financials and kind of rides the next thing. But I think what is also a maybe more realistic behavioral scenario is people start freaking out and they don't just go into other things, they go risk off. And we might see initial moves in these other things, but you saw how the weakness in big cap, mega cap growth eventually dragged everything down with it. And I think that's the risk to this market, is that the heaviness in an unwinding AI trade could kind of pull everything down a little bit. Having said that, if chart's still good, a chart's still good. I'll show you a travel and tourism made a new 52-week high today. So there are stocks that are still working just fine. It's just generally, this is potentially dangerous setup here. Volatility pushing higher. The VIX moved up by over a full point to 17.6 or so. So we're still below that high volatility threshold of 20, still in a low volatility environment, but definitely something to watch here. We've now seen the VIX kind of pushing higher here today, as there's that initial, further pullback that started sort of the end of last week in mega cap growth. Bond markets didn't change a ton. The TLT major index, major yields across the yield curve were essentially flat today. This wasn't a big movement day in the fixed income market. The movement was really in the equity space. Dollar, not much of a change as well. Gold and especially silver continuing to impress. Silver up another 4.4%. I feel like since the time we've been talking about silver earlier this year, but it just keeps going. Gold just keeps going. And this is why I still have a decent bet on precious metals, because the charts still look good. I am thrilled to unwind positions like Bitcoin, of which I now own none. I owned a lot before earlier this year, but it's like when the chart tells you it doesn't deserve a place in your portfolio, it doesn't deserve a place in your portfolio. At least that's my approach. And then I'll wait for the chart to tell me it's time to get back in. So gold and silver especially continuing to have a pretty decent week here. Copper prices higher, crude oil prices bouncing up. Now, this is after getting absolutely crushed earlier in this week. Energy stocks all breaking down and having a nice counter trend rally. We'll see if that sort of evolves into something more sustainable, but certainly a bounce to watch. Kind of a weird chart on Bitcoin today. So we actually spiked right up to 90,000. I mean, almost precisely to 90,000 before this run stalls out and we rotate back lower. So Bitcoin now making a bit of a swing low here, down another 2.25%. Ether prices down almost 5%. All 10 of the top coins on the stock charts platform in the red. I see these as bearish charts until proven otherwise, and they're continuing to head lower. On the sector side, 4 of the 11 S&P sectors in the green today. Energy up 2.2%, followed by consumer staples, real estate, and materials, which all managed to have an update. Financials were basically flat for the day. And on the downside, big loss in technology, down 2.2. The XLK is about a third of the S&P 500. So that negative 2.2% hurts pretty bad. Industrials down 1.6%. Consumer discretionary, including Tesla, which had a big reversal day today, a bearish outside day, as you'll see from the chart in a few moments, down 1.2%. So value over growth, more defense over offense today. And certainly, a lot of signs implying some negative rotation here. A couple other things here. Breadth wasn't horrible, to be honest with you. On the New York Composite Index, 53% down, 45% up. So it could be better, but not horrible. On the NASDAQ, pretty negative breadth. Obviously, growth stocks were getting hurt pretty good today. But in the S&P, more stocks up than down. Same in mid caps, same in small caps. Problem is, it's the wrong stocks that were down and the wrong stocks that were up to keep the indexes in the green. So with generally neutral breadth, the indexes were still down, and that's the challenge with the market here. The market trend model, which is featured on this widget on the stock charts platform, hasn't updated yet for today, but it looks like the short-term model would turn bearish on the S&P 500 with today's close. If this was the end of the week, I don't formally update the model until Friday's close. So for now, still bullish on all time frames, but it certainly looks likely, barring some big recovery on Thursday and Friday. It looks like our short-term model will turn bearish for the 4th time since the April market low. Those previous 3 times have been great buyable dips, most recently in November. We'll see if we get another one of those. I don't think anyone would complain about that. On the Magnificent and 7 and Friends growth stocks, Netflix up about 0.25%. That's the best I can tell you. Microsoft flat for the day. This is one of those stocks, kind of testing the 200-day moving average, as is Amazon. both kind of holding them, but close. On the downside, this is the problem. Tesla down almost 5%. This is after making a new swing high yesterday. Broadcom down another 4.5%. This is after their negative news last week. Other technology, particularly semiconductors, struggling today. We'll show you the chart of Micron, which is looking less awesome by the day, and NVIDIA down 3.8%. Alphabet down over 3%. Big risk-off day, particularly in the growth space. We're going to get to the heat map here in a moment. I want to thank all of you that attended our webcast earlier today. I had a really fun discussion. I had some great initial feedback during the session, and then some really kind emails that I received afterwards. I'm glad you attended, those that did, and I'm glad you enjoyed it. I shared with you the 10 questions every investor should ask at the end of the year. Winners, losers, and lessons. And we talked about sort of that natural process of reviewing performance. You can check out the replay if you like at marketmisbehavior.com/lessons. That replay will be available through the end of the month. Just enter your name and your email address so I know who you are. I'll let you take a look at the replay. I'll leave that available for you. As long as you sign up on that page, you'll get the handout, which actually has the 10 questions and then places for you to answer it. It's a really helpful exercise. I've done this for a number of years. I would invite you to do so as well. And I hope you find it's a helpful way to wrap up the year and hopefully set yourself up for some great success in 2026 and beyond. All right, let's look at the heat map here. A lot of red, particularly in the left half, the left third of the heat map. Upper left corner is the technology sector. Overall, the S&P 500 technology stocks make up about a third of the total weight of the S&P 500. Is by far the biggest sector in the S&P 500. And look at all of the stocks that are down today, right? And some of these names have been struggling for a while, right? Oracle has been going down since September, to be honest with you. But others like Micron coming off of new highs, but they're showing bearish divergences and rotating lower. AMD now making a lower high and potentially a lower low, pushing right down to $200 a share, closing slightly below there. So seeing some concerning rotations here, certainly in the technology sector. And I mean, the most concerning, I mean, there are a number of concerns that I have. There are kind of three general buckets of charts in technology right now. And I'll show you each one of them really quick, just so you get an idea. Example one would be the breakdown names. These are names that are already going down, like Oracle has already broken down below its 200-day moving average. And these are things that actually have been down so far in the fourth quarter. So they've actually been fairly negative charts. And the problem is they're just not getting any better, right? This is a bullish environment. A stock like Oracle, a leader in the technology sector, you would expect it to find some stability, right? Find some footing where if investors are all bulled up, they're going to buy weakness in leading companies. And I'm not seeing it on the chart of Oracle. To the contrary, I'm seeing a gap lower on earnings and then just continue to drift lower after that earnings. The second bucket would be probably the most positive bucket. These are stocks that are still, I would argue, in primary uptrends, making higher highs and higher lows. The problem is that a lot of these are making bearish divergences, right? Higher highs in price, lower peaks in momentum. So even the stronger charts are not really showing supportive momentum. And then the third bucket would be the CrowdStrike names that are just starting to make lower highs and lower lows, right? They're sort of just, they feel like they're rotating. A lot of these look like head and shoulders tops to me, right? And I'll show you exactly what I mean. We'll zoom into like the last 9 months. Here's the rally off the 200-day moving average. Here's the trend line. Basically a neckline. Let's actually make it accurate, Dave. Here we go. Here's the high. Here's the left shoulder, right shoulder. We break below the neckline today. I mean, that's a classic topping pattern. And I think with today's sell-off kind of confirming that. Now, on a breakdown like this, when we break through the neckline, I always look for follow through the next day. So I think Thursday's session could be pretty important. Do we get a nice snapback rally tomorrow? That would be less bearish for sure. But for now, the setup certainly looks toppy, and we've now made a lower high and now making a lower low. And that's what a head and shoulders top is basically the uptrend turning into a bit of a downtrend here. So in technology, I think those are the three buckets, and I'm concerned about all of them. None of those look particularly strong. In communication services, actually Alphabet, which has been one of the strongest Mag 7 names, pulling back here so far in the month of December. It's down another 3.2%. Not the end of the world. but something to watch. Tesla, we'll look at the chart here in the middle, so put a pin in that one. We'll come back to it. Industrial stocks, a lot of these are pulling back. Like Caterpillar made new all-time highs last week, pulling back about 4.5% today. GEV, which just came off a new all-time high, pushing about $700 a share for the first time, pulling back again another 10% to the downside today. So some concerning breakdowns in some of those names. Not all bad though, right? And then you have a chart like UPS, which is arguably a pretty decent setup, right? Breaking, we kind of have this coil pattern of lower highs and lower lows. We gap higher, we pull back a bit, and then break above the 200-day moving average. And from there, it's been kind of lights out positive. So it's interesting with so many of these charts that I mentioned. It's not all bad though, because there are, they're just in different sectors, right? It's in industrials. It's charts in the financial sector, which are still pretty good. Like JP Morgan's down like 0.2%, but coming off of a new all-time high. Schwab is very close to making a new all-time high. Wells Fargo made a new all-time high this week. So, there are sectors and setups that are actually pretty constructive here. It's just not in these growthy sectors. And I think that is one of the big rotations we've been highlighting. My latest podcast interview with Julius DeKempener. Please do yourself a favor and listen to that one. That was a really fun discussion digging into this rotational element that we've been talking about, and I think very much still relevant here. All right, let's look at some charts together, shall we? Looking at the daily chart of the S&P 500. Here's our traffic light. This is why we have a traffic light, right? 6,900 for us was the threshold. Anything above that, pretty bullish. Anything not above that, just not quite bullish enough yet. And unfortunately, this week, keeping us off of that all-time high around 6,900. Literally from the moment I threatened to play my trumpet on the air to celebrate the S&P breaking 7,000, we've failed. I feel partially responsible for creating this pullback by the market gods, so I don't have to play my instrument on the show. But we've pulled back here, and the last week has literally, we've tagged 6,900 to the button and now pulled back here. The S&P closing below its 50-day moving average for the first time in December. Most recently, that last test of 6,900, the RSI didn't get much above 60. So certainly feels like this is a, retest of the previous highs. It's more of a sideways trend, lack of follow through, lack of optimism, lack of upside momentum, calling the market to stall out. It's not a bad chart. I mean, there's nothing bad on the chart of the S&P yet. There's things that are less good. There's things that are telling me that, to be cautious and to not be, bring my expectations way down about, strong gains at this particular moment. But it's not bad. The S&P below 6550 becomes a bad chart, right? That looks like the chart of CrowdStrike and others that have a clear topping pattern, and we're breaking below that support. S&P's support is a couple hundred points below the current levels, right? It's down around 6550. That's 180 points away from today's 170 points is the math. Below current levels. So it's getting closer with the day like today, but we'll see if the 50-day, this close of the 50-day results in some break tomorrow. But for now, we still are very much in the yellow light here. As the S&P chart has remained neutral again, so deterioration underneath the hood, the McClellan oscillator, which is literally based on the slope of the advanced decline data on the New York Stock Exchange, breaking below zero. It's been above zero since just before Thanksgiving, when the indicator had been below zero during that November pullback, had been above zero from late November all the way through yesterday's close. Today's close, the McClellan oscillator dipping below zero. We'll see if that continues, but that indicator getting below zero tells us we're probably in a pullback scenario of some sort. Now, the severity and the length and the depth of that pullback can take many different forms based on the signal, but it does tell me to just be prepared for not breakout today. The volume is less supportive as well, as we've had these big down days on increasing volume, right? Every down close in the last week has had much heavier volume than the up closes we were seeing back here. So that heavier volume is causing the Chaikin money flow to go down, right? Heavier volume on down days implies distribution, and it indicates that investors are selling, and that selling pressure on heavier volume implies people trying to get out of the way of the market. And so that is causing the Chaikin money flow to turn negative for the third time in Q4. The previous two times in early November and in late November, both of those ended up being decent bounces. We'll see if we get a repeat of that. But overall, negative momentum, I generally don't think of as pretty positive. Again, not a horrible breakdown scenario just yet by any means. The volatility still remains low, although it is increasing day in, day out. Over the last week, the VIX is still below 18, which means we're still below 20, which means we're still in a low volatility environment. But that is definitely a chart I'm watching for a red flag kind of moment. I mentioned unwinding my, at this point, entire position in Bitcoin and Ethereum. At one point, I had a decent bet going over the summer. Kept a lot of that going on into October. But from October 1st to now mid-December, I've been unwinding parts of that. As the chart has gotten less ideal, as we've broken levels, each one of those breaks has caused me to exit some part of some position. And at this point, I'm out completely. And part of that is because the last thing I'm thinking was, all right, we're down 32%. That was what the pullback in February and March was. We then had an improvement, a breakout on stronger momentum. And if we can get that, maybe this is a big bottoming pattern, but we did the opposite. We've now broken down and the momentum has turned negative. So at some point, this chart starts to look constructive again, but I'm seeing this as more of a breakdown chart. I'm seeing this as a bull flag. And I think the break below 88,000 here, really going into this week, coming out of the weekend session, certainly implying weakness over strength for the chart of Bitcoin. Growth over value. We've definitely seen this rotation. Again, my interview with Julius de Kempener talked about using the RRG to sort of show visually that rotation from growth into value. And that's been a thing that's been brewing here quite a bit in the fourth quarter, this leadership rotation. Days like today are a reminder that when growthy stuff stops working, you want to rotate out of growthy stuff. And when value kind of things start working, you want to rotate there. And when defensive sectors start working, I'd consider moving over there. And that idea of following the relative strength, following the charts has been, one of the most important parts of my own process. I'm seeing a clear rotation on this chart as the ratios are going down. That means value is outperforming growth. And really from the end of October through mid-December now, for the last 6 weeks, growth has been underperforming value. Now that's using the traditional growth and value indexes, using the Russell 1000 growth and value. And these are the ETFs that track those two indexes. If you look at the pure growth versus pure value, so these are the stocks that are not double counted, because a lot of stocks are actually considered both growth and value because they show a lot of those similar characteristics. But if you look at the kind of pure growthy stuff and the pure value stuff, that's actually been favoring value since the end of July. And that's why this chart has become a chart I've referred to quite often, right? As we're going into that October peak, it's like, well, hold on. The fact that this pure growth ratio is going down, it tells you it's those big established blue chippy companies like Microsoft that are still so strong that is causing this ratio to go up while this ratio is going down, right? When you ignore those big mature growth companies that are also more value-y, more blue chippy, the other stuff is really more value oriented. And that's really what we're seeing here. That rotation, we can look at it in a couple ways, but just to show you what's happened in the last week, and I don't have labels on these. I apologize. I didn't have time to put them on here, but if you follow me, I'll show you. Starting at the bottom, this is Bitcoin, and I'm taking it from the November 17th market low. That's when the S&P had its most recent dip. That was the swing low before we moved higher into December. So in blue, that's Bitcoin. It's down 6.7%, 6.6% since that November swing low. Bonds are down about 1.1%. The line at the top is gold, which is actually trending higher. So it's actually making a breakout here, up about 7.4%. Here are all the equity indexes, right? So this is the NASDAQ in red, in green is the S&P 500, in purple is the equal-weighted S&P 500, and in black is the Magnificent 7 ETF. All of these are kind of moving up in a very similar move to gold. Even through the first week in December, it was like gold and stocks all kind of doing a similar thing. But look how gold has now continued with the next leg higher, but all the stock indexes are rotating lower. So it's like Bitcoin, cryptos, and stocks have now rotated weaker. Gold, precious metals continuing higher, bonds continuing lower. And that's kind of where we're at here. Let's dig into some of these Magnificent 7 charts in particular. We highlighted last week Broadcom's gap lower. That was one of those big, I think if this ends up being some major top, I think we can look at that news from Broadcom as maybe straw that broke the camel's back, the nail in the coffin, whatever analogy you want to use or metaphor for what we're seeing here, sort of that sign to investors that this aggressive AI infrastructure spend is not immediately resulting in dramatic AI earnings, right? We're bringing in revenues, but we're spending so much that it's not really causing companies to generating a ton of earnings, right? These big technology companies generally are taking on a ton of debt to grow AI because of the race to AI greatness. It's not how you earn a lot of money for spending too much to generate those future revenues. So Broadcom gapping lower last Thursday. Is that true? Friday? Monday, Tuesday, Wednesday, continuing to close trend lower here. Today, making a new swing low. I had an alarm set for when Broadcom closed below 325. That actually triggered earlier today when it traded below 325. That triggered, suggesting to me, potential breakdown scenario here. I'm watching that where we just traded below it today. So we'll see if there's further follow through. We might get a bounce off of that support level, but down another 4.5%. Momentum not looking great. I already went through some of the technology stocks, but just to confirm, this is the bearish momentum divergence. What concerns me is the charts within technology that still look the strongest. A lot of them are showing this bearish momentum divergence. So even the ones going up are going up on weaker momentum. It's not a great sign for Micron. It hasn't broken down yet, holding the 50-day, but in a vulnerable position. Alphabet looking to hold the 21-day EMA, but today closing below it. And so we're seeing a potential breakdown. Still one of the better charts you can find. The RSI still good, with the RSI remaining above 44 now. But the fact that we're breaking below the 21-day EMA, just an initial warning sign that Alphabet may be pushing lower here. Here's Tesla. And it's not a bearish engulfing pattern because we had a lower open today. We opened below the yesterday's close, but it's almost a bearish outside day. And it isn't really because we didn't trade below yesterday's range. So it's kind of a non-thing. There might be some obscure name to this 2-bar pattern, but I don't know what it is. Nothing that particularly comes to mind, but I'll have to think about it. It's not any of the common ones just because of the kind of unique nature to what happened here, but certainly doesn't seem bullish to me with the big strong up day yesterday, big down. It's almost like an engulfing pattern, not quite there. Almost like a bearish outside day, but not quite there, but certainly implying a short 2-day reversal from a killer breakout yesterday to a, giving back pretty much all of those gains today. Last chart of the episode, it's not all bad. And I think that, when I was going through the 10 questions earlier today, if you caught the webcast, it's like one of the things that I've thought a lot about reflecting on the fourth quarter, which has been all about rotation. It's remarkable when you see the unwind of this AI trade, at least just to the degree that we've seen so far, which has been at least some rotation away from some of these leader names. Like they're showing some vulnerability. Charts like Hilton are making new all-time highs today. HLT up 2.5% today. So there are stocks out there that look great. There are charts that are breaking out. There are charts that are in basing patterns. And if you just look for the new 3-month high, you'll find opportunities with strong momentum and improving relative strength. So what's encouraging to me is there are still charts out there that look very, very good. It's just not in the names that we remember being so good over the summer. Even in the third quarter, the fourth quarter has been rotating away from that other stuff and into names like Hilton, which all of a sudden look like great breakout candidates. So great reminder to make sure your process involves looking for ideas, looking for breakouts and breakdowns. I hope what I do on this show can be part of that success process for you. I'm thankful that you watched today. I'm thankful if you come back tomorrow. And I wish you much investing success as you reflect on your own performance in 2025. Again, you can check out the replay of our webcast today at marketmisbehavior.com/lessons. Just drop your name and your email so I know who you are, and you're welcome to check out the replay. I hope you find it's a good exercise. Do it. Pour yourself a cup of tea, watch that, reflect on the questions, and I hope you find that time well spent. For Market Misbehavior, I'm Dave Keller, reminding you it's always a good time to own good charts. Have a good night, folks.